Hello, and welcome to this lesson on how to avoid trading distribution programs. I decided to do this video or lesson because of what we saw on Gold on Friday. Now, I already made a post on Twitter that I was going to do a lesson on distribution programs. Now, I'm sure a lot of you guys understand what accumulation program is and what distribution program is, but I want to explain some subtle differences. And these are differences that I've applied to my trading model, and I've included them as a part of my low probability trading market conditions. So I have certain criteria in which if I see the market in that criteria, that is a signal for a potential low probability market condition, and I know to avoid. And what we saw on Friday with gold was a classic example. Now, the problem with this was a lot of people who were buying gold on Friday, because if you go and take a look at DXY, which I'm going to do shortly, so let's just go and take a very quick look at DXY and what we saw last week. So DXY was generally bearish, and that's what I was looking for, and that's why I was bullish in foreign currencies. So now you can see we had weakness on dollar on Friday last week. And of course, if dollar is weak, we want to see strength on foreign currencies. And not only foreign currencies, we also want to see strength on commodities. And gold is a commodity, right? And what we saw on Friday was we saw a weakness on DXY, right? So if we go and take a look across the majors, you can see euro was bullish, of course. So that is the normal symmetry once in the marketplace. Pound was bullish. And this was the trade I took, and I'm still on this trade currently. USD CAD was bearish, and again, this was a trade I took, which I exited all positions off. And Aussie was bullish, of course. So you can see that there's normal symmetry in the marketplace, right? So the correlation between dollar and currencies is if dollar is bearish, we want to see strength on foreign currencies. Now, before I continue with this presentation, I just want to do like a very quick. There's going to be some of you guys who are new to my style of approach to teaching. And the one thing I like to explain, or the one thing I like to inform people who are new to my stuff, is I don't like to teach from hindsight. I really don't like hindsight. And the reason why I'm saying I don't like hindsight is because I understand, and I've fell victim to this in the past, there's a lot of people who would use hindsight analysis or lessons to sell courses and stuff. And then when it comes to a live setting, it's so difficult for them to replicate the clinical theories. So I like to be really practical about the things to talk about, right? So that's why I like to use really recent price action, and also price action I engaged in, whether I had a winning trade or a losing trade, just always something to learn. So the things I talk about are things from my journal, things from my own personal experiences, and I have been trading since 2016. So I have around, I think, 7 to 8 years of experience trading, and also around 6 years of trading, quote unquote, institution style trading. So we're going to talk about accumulation programs, distribution programs, what we saw on gold, how to avoid that on gold, and the most important part is what I call the conclusion, right? So when I do lessons like this, there has to be a conclusion, and the conclusion is how can you incorporate this into your trading model so that in the future, because that's the goal of journaling. The goal of journaling is to gain experience, learn how to make better decisions, and then incorporate that into a new trading model. So that would be the point of this presentation. Now, before I go back into the lesson, one more thing, I do not edit my videos whatsoever. I don't cut nothing. I don't remember some words. And that's why a lot of times I like to leave in the start of the recording and also the end of the recording. So if you're watching this, you'll probably have seen me start the recording, and you're also going to see me end the recording. So if I make a blunder, just understand it's a natural part of this. And so yeah. Okay, so we're going to get into the lesson. When we see bearishness in DXY, the natural expectation is to see strength on the foreign currencies. Now, I'm going to talk shortly about the different asset classes, right? So there are different asset classes, and we're going to talk about how they're all intercorrelated or interrelated to one another and how they all correlate to dollar. We're going to talk about dollar. But before I go and show you that presentation, let's take a look at what we saw in gold on Friday and what gold actually did on Friday. So now you can see in gold we were rallying from Wednesday, and I actually bought gold. I bought gold and I scaled and scaled and scaled and scaled until we got up into the rejection block. Now, this kind of move in gold, it is not out of the ordinary. It's not something that is unexpected. Gold oftentimes can behave like this. So if you just go back and look at price action, you're going to see that gold can behave in this extreme way where it'll be rallying and all of a sudden it goes. You can say this as an example. It just goes and takes out stops and then continues to run higher. And we saw this on Friday. Now, what's different, and the reason I'm doing this video was because I had a conversation with a friend of mine who was also long on gold, like I was on Wednesday, and he actually flipped his account from $500 to $28,000, which I don't encourage at all because it is not sustainable. Okay, flipping an account is not sustainable. So if you want to flip accounts, do it with money you're willing to lose, so you're not overthinking your trades. Okay, but he was able to flip his account from like $500 to $28,000 between Wednesday and Thursday, just trading gold on buys. And on Friday, he waited for gold to drop down into what he thought was a discount. And he thought, I'm buying gold at a discount. So, of course, I expect gold to rally because, and this is the main point here, and this is also a reason why a lot of you guys were confused about what's on gold. And you needed clarity or explanation as to what happened on gold. And that's the point of the lesson. So, if you look at gold on Friday, we saw this massive decline on gold. But if we're going to take a look at DXY and see what DXY was doing, DXY was also bearish. So now we have weakness at DXY. We have strength on T-bonds. By the way, if you don't understand the correlation between gold and T-bonds, gold is closely correlated to treasuries, T-bonds. T-bonds is the inverse of interest rates, and gold, is aligned with U.S. treasuries. So if we see higher treasury prices, we generally expect higher gold prices because higher treasury prices equals lower currency prices for dollar, and that equals higher prices for gold because gold is valuated against dollar. Now, we saw bullishness on T-bonds on Friday, like I expected, right? So strength on T-bonds on Friday. So you can see this is 30-year T-bonds. The code is ZB1. That's a continuous contract. We have 10-year T-bonds. We have 5-year T-bonds. So they're all bullish, right? All of them are all bullish. And the expectation is if T-bonds is bullish, then we want to see weakness on gold. Not weakness, but strength on gold. But now, if you go and take a look at gold, gold moved not just in a consolidation. Now, typically, if DXY is dropping and gold is predetermined to sell off, gold typically would not sell off while dollar is bearish. Gold typically would consolidate, and then if dollar is retracing a little bit, you're going to get the sells you're looking for. But on Friday, what we saw in gold was we saw gold tank massively against the bearish dollar, and that caught a lot of people off guard. And I wanted to explain this from an institutional lens, institutional perspective. But before I go and explain from an institutional lens and perspective, we need to understand correlations, how the market is tied to one another. So that brings us to the next presentation, or not presentation, the same presentation actually, but the next slide. And here, what I've done is I have done a very rudimentary drawing of the different asset classes. So we have 4 asset classes. We have currencies, we have commodities, we have equities, and then we have treasuries or interest rates. These are the 4 main asset classes. Now, the thing about these asset classes is that they are evaluated for the most part against dollar. I'm sure you've heard about dollar being king. If you're a trader, you already know everyone says dollar is king, and that's still factual. Now, maybe the weight of influence dollar used to hold across these different asset classes, maybe it's not as pronounced as currently, but dollar is still king. It still has a lot of influence in the marketplace. So now let's try to understand the correlation between dollar and these different asset classes. So here's a correlation. If DXY is going up, if DXY is bullish, remember dollar is a currency. Okay, so but I'm taking dollar because all other asset classes, they are evaluated against dollar. Okay, now if dollar is bullish, we expect generally, I'm not saying all of the assets in these asset classes are going to move in sync, but I'm just saying in general, if we anticipate or we're seeing a bullish DXY, then we expect to get bearish currencies, bearish commodities, bearish equities, and bearish treasuries. Okay, that's the expectation. If dollar is bearish, then we expect to see bullish currencies, bullish commodities in general, bullish equities, bullish interest rates, and bearish T-bonds or bearish treasuries. That's the expectation we want to see in the market class. And these are the four asset classes that makes up the global exchange market. Okay, so let's talk about gold. And if you look at my watch list, what I have here is I have three different asset classes. I have currencies, and of course you can see dollars there. Dollar is a currency pair. I have currencies. I have treasuries, right? That's a different asset class, which is T-bonds here. I have more currencies, which are essentially just the majors. And then I have commodity, gold. Now, commodity has its own subcategory of assets. So under commodities, you would see assets like energy, where you get things like oil. You would see assets like metals, which is where you get your palladium, gold, silver, copper. And so metal or gold is a commodity under metal, which is a sub-commodity under the asset class we know as commodities, right? So your other commodities like cocoa, linox, beans, rice, cattle, these are all commodities, right? So commodities has its own vast set of assets, and gold is just a part. It's just one asset under subcategory of commodities, and that's its own asset class. So the correlation between DXY and commodities is if we're seeing strength on dollar, we want to see weakness on commodities, right? And what is the correlation between gold and treasuries? If treasuries is bullish, that would indicate that dollar should be bearish, because again, remember, treasuries is a fundamental reflection of dollar. So when we talk about fundamental analysis, we're talking about interest rates. Okay, so if we're seeing a bullish treasuries, that means interest rates are lower, and if we have lower interest rates, then that means the value of the currency should be lower. And if dollar is going to go lower, that means gold should go higher against dollar, because gold is valued against dollar. Literally, it's in the pair, gold spot versus dollar. So if we have weakness in dollar, then gold should by default rally. But now the problem we had on Friday was we had weakness on dollar, but gold was also weak. So that means gold was fundamentally massively bearish. And so this is the main point of the video. Let's try to understand what was going on. Okay, what was going on with gold? Let's try to understand it. And to understand what was going on with gold, what we need to understand is accumulation versus distribution. We need to understand accumulation versus distribution. And so this is where I go and find a random pair, and we use that for our annotations. And I think I'm going to do GBP CAD as one. And so the next subtopic is trying to understand accumulation versus distribution. I promise you guys, this is going to make a lot of sense. It's going to make so much sense. It will blow your fucking mind. You're going to bookmark this video and come back to multiple times, because this is going to be absolutely insane. And that's what you're going to get with my YouTube channel and my videos like this. I do videos that are necessary from real-time price action. I'm not doing hindsight. I'm not trying to teach you stuff from 2008. Okay? I am essentially, when I do videos, these are things that I journaled from the current week, and I traded and I navigated through. And so you would learn from my experiences or my losses, but I'm always going to be transparent about my experiences. So I guess there's that. And let's talk about accumulation versus distribution. Now, to explain the concept of accumulation versus distribution, what I'm going to do here is I'm going to draw a candle. Okay, so hopefully all those time I was selling comics in high school pays off for my drawing. Although this is a really basic drawing, but still. Okay, so this would be a bullish candle. So we're just call this a bullish candle. So a bullish candle is a candle in which the close of the candle is higher than the open of the candle, and a bearish candle is a candle in which the close of the candle is lower than the open of the candle. So really simple and easy to use definitions of bullish versus bearish candles or candlesticks. Now, this is a typical classic candlestick, a bullish candlestick. And to even emphasize my point, I'm going to make this green and increase the color a little bit, even though this is not the appropriate green, but it's still green, so that works. Okay, so we know this is the open of the candle, this is the low of the candle, this is the high of the candle, and this is the close of the candle. So that's how you get your OHLC, which is what you can see here. O, which is open, H, high, L, low, C, close of your candle. And then, of course, this is the change between your open and close of your candle. So really basic stuff. And how does this relate to accumulation versus distribution? How does this relate to gold and what we saw gold do on Friday? It's going to make a lot of sense. Now, this candle is a weekly candle. Okay, so I'm going to put this here as a subtopic, and that is a weekly candle. So that's a weekly candle. Now, this is how a weekly candle forms. If we see a bullish weekly candle and we strip everything down to an institutional lens, and we try to understand the weekly candle from an institutional lens, this is how it goes. You have your opening price of the candle, candlestick open, and typically the institutions will accumulate longs below the open price of a candle in a bullish order flow. When order flow is bullish, let us understand what order flow is. Now, the reason I'm going this rudimentary in my analysis, or in my explanations, not analysis, but the reason I'm going really, really basic in my explanations is because a lot of you guys, this is going to be available on YouTube, and you guys have not, maybe you don't join my live streams, or you don't, you're not people, you're new to me essentially. So I have to explain really basic concepts. Order flow simply is the provision of liquidity by the central banks to the large funds. That's what we understand as order flow. So in a bullish order flow, meaning the trend is bullish, the institutions will accumulate longs at or below the opening of the candle. So if we can do this, the institutions will buy. When it's accumulate longs, essentially you're buying. They would go and accumulate longs below the opening price. Now, what happens with this candle is this initial decline at the start of the week is what we know as valuation by speculation. It's a different topic entirely, and it's a different concept entirely. But just to explain or summarize the concept, valuation by speculation is when the market makes a sudden move against the intended weekly direction. And that sort of move against the intended weekly direction usually entices a lot of retail liquidity. Okay, so again, I know I'm retail. When I say retail liquidity, I just mean uninformed money. They'll chase the initial sells by being sellers because they think that's the trend. And institutions will then go and buy at a discount. And then the algorithm will start to expand for higher time frame counterparty liquidity. So institutions will go and accumulate longs below market opening price, and oftentimes unwilling liquidity would be part of that sell side liquidity that institutions would be counterparty to. Okay, and then the algorithm would kick in and then seek a counterparty liquidity at premium. Now the main question is, why do we need to get this expansion? Well, because the entire premise of the market is liquidity. That's what makes the market go around. If you take a trade without the ability to exit that trade, then essentially you can't trade because you're going to have a stock. What's the point holding a profit when you cannot cash out the profit, if that makes sense? Okay, so that same concept, again, it's a really, really basic concept, but that same concept applies to institutions, the large institutions. So if they are accumulating a discount, the algorithm needs to expand to a premium that would entice newer longs, which I call weaker longs, right? And also shorts who want to go against the trend because they think they're smart, and institutions can be counterpart liquidity to them. Okay, and so it's a whole. I'm just saying the basic version of this. It's a whole deeper stuff underneath all of this. But just to understand what was on gold, I'm just doing this really basic explanation of accumulation versus distribution. The accumulation cycle is where institutions will accumulate against the intended direction of the trend, usually at a discount. So if we're bullish, they would accumulate at a discount. Longs, if we're bearish, they'll accumulate at a premium. Shorts, and then the algorithm would seek to offset the longs against what I call unwilling liquidity at a premium. And this is where we get the distribution. So as the market starts to trade above the open price, where institutions were accumulating longs, you start to see a lot of inefficiencies. And this inefficiency is a signature of algorithmic expansion. It's not an influence of buying pressure or selling pressure. It simply is an influence of algorithms seeking counterparty liquidity as fair value for these institutions to exit. Now, this expansion phase is what we'll call the profit release phase. Okay, so this is the profit release phase. Profit release phase is where the algorithms kick into effect, seeking counterparty liquidity. So this is profit release phase, and then we get to the distribution phase. Now, the distribution phase is where we start to see squaring of positions. Okay, so I'm gonna do the same drawing like in the first one. And in this phase of the weekly candle, institutions will offset existing order flow against counterparty liquidity. At this level here, institutions will go and then offset existing order flow against counterparty liquidity, and this is the distribution. Now, let's understand the characteristic between this phase and then this phase, because that's the whole point of the lesson. So this is the distribution phase. And so that's our distribution phase, and this is our accumulation phase. Okay, so we have an accumulation phase, and then we have a distribution phase. So accumulation phase here, where institutions will go long below market open against order flow, and then distribution phase, where these same institutions will exit their now profitable positions at a premium. Now let's understand these two phases. In the accumulation phase is always going to be in the direction of the trend. Okay, so if the trend is bullish, institutions will be long, because institutions by nature are trend following. They follow the trend. Now, of course, at market reversals, they will be cannibalized on by other banks and sometimes central banks, but these institutions will buy in a bullish order flow and they'll sell in a bearish order flow. So in a bullish trend, institutions will accumulate longs at discount and distribute said longs, profitable longs, at a premium. Now, at the accumulation phase, we get algorithmic sponsorship. And one of the functions of sponsorship is market symmetry. And this is where we get into the really important part of our lesson today. Okay, it really is important. One of the functions of sponsorship is general market symmetry. When there's order flow, when liquidity is pouring into an asset class, that should reflect across all the correlated asset classes. I'm going to give you a while to digest what I just said, because this is going to be a game changer for a lot of you guys. When we see sponsorship, bullish sponsorship, One of the functions of sponsorship is asset symmetry or market symmetry. And then the algorithm drives the market up to a premium, and then we start to get distribution. The distribution essentially is offsetting existing liquidity. When we start to, or when we begin to offset existing liquidity, it's always going to be against order flow. When we start to exit existing liquidity, a lot of times you are going to get asymmetry in the marketplace. And this should not be a surprise at all. We're going to talk about the characteristics of distribution. Distribution will occur at counterparty to existing order flow. So if order flow was bearish, distribution would occur at a discount. If order flow was bullish, distribution would occur at a premium. Why? Because to exit your position, it needs to be profitable, right? So the characteristic of distribution is distribution would occur at counterparty liquidity to the current trend or order flow, right? So if you're comfortable calling the trend, call a trend. I like to call it order flow. So if order flow is bullish, you're expecting distribution at premium, or if the trend is bullish, you're expecting distribution at a premium. And also one of the characteristics of the distribution phase is what we know as asymmetrical markets. And this is where I'm going to clear up all of this. And now we're going to talk about the characteristics of distribution. Gene, can you just explain why gold is bearish? I don't understand all these long explanations. Why are you doing all these long lessons and explanations about distributions? And I just want to know why gold is bearish, bro. What the fuck is all of these things? I promise you it's going to make sense, okay? I'm not just yapping. I'm trying to make a point. I'm trying to explain fundamentally so you understand. Because a lot of people, when they learn about the markets, they learn from the perspective of, can I find a trade now? Can I take a trade now? Can I just take a trade? Can I just make a model? Da, 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 da. And my thing is, you have to learn the fundamental reason why the market does something. You have to know why the market does something. Because if you know why the market behaves in a certain manner, then it is easier to avoid losses because you understand market behavior. And that's always going to be my perspective when it comes to educating or doing lessons like this. So now let's understand the characteristics of distribution. Distribution would always occur at a counterparty to the trend. If the trend is bullish, distribution would occur at a premium. If the trend is bearish, distribution would occur at a discount. So I'm sure by now this is already like I've repeated this multiple times. So this is something we already know by now. And one of the characteristics of distribution is characteristics of distribution is asymmetrical market. So an asymmetrical market essentially is a market in which supposedly correlated assets are not moving in correlation. So one asset can do one thing, another asset can do another thing, another asset can do another thing, and a lot of times that messes up a lot of traders because now they don't understand what the fuck is going on. So you're usually going to get asymmetrical markets when the market is distributed at a higher time frame counterparty liquidity, and even sometimes when the market is accumulating, aka a consolidation profile. When the market is in a consolidation profile, order flow is neutral. So because order flow is neutral, you're going to get asymmetry, or what I call decoupled markets in price. Okay. Now we're not talking about consolidation profiles. Consolidation profiles, they're a whole different topic entirely. The goal of this lesson is on distribution profiles. And a part of distribution profiles is asymmetrical markets. Okay. Now, in these kind of distribution profiles, what is going on is you're seeing an exit of liquidity, and at times In distribution cycles, the market will seek open flow liquidity. Existing profitable open flow liquidity from weak longs or shorts. And I know I'm getting into something that you guys are wondering, what the fuck is a week long or what the fuck is a week short? I'm hoping if you're watching this lesson, you're above the age of 18 so I can cuss. If you're not above the age of 18, what I want you to do right now is turn off this video and go back to class, go back to school, high school, okay? You're not supposed to be watching me cuss on the live stream. Or if you're going to watch this lesson, make sure your parents are around so they can tell you off for listening to a cuss word. Anyways, I'm joking. So let's talk about week longs versus week shorts. So in a bullish order flow, we get higher highs and higher lows because the market is making new levels of a discount. So the market goes higher, higher low, higher high, higher low. Sometimes you might get a stopper and below a low, but still all this generally gonna be higher highs and higher lows. Okay, and we'll talk about this. And in the bearish trend, we have a lower high and lower low. Lower high, lower low, lower high, lower low, lower high. Sometimes you might get a stop run, okay? And lower low, lower high, lower low, and then this, which we're going to talk about. Okay, so this is a bullish market structure, and this is a bearish market structure. Now, let's understand the concept of weak longs versus shorts. And to fully explain the concept of weak longs versus shorts, what I want you to imagine is, imagine Bitcoin, the first time we broke 69K. I think that was 2021 or 2. Okay, so let's go and take a look at the chart of BTC US dollar. So Bitcoin, US dollar, if you go all the way back, you're going to see there was a time where we broke above 64K and the market made a top at 69K. That was 2021. Now, if you remember at this point, I'm going to use a replay tool just to explain the psychological manipulation that went on here. And I want you to be really, really honest with this. If you're looking at Bitcoin at this point, you are probably thinking, this is a massive trend. Oh Lord, I want to be a part of this. And that was reflected across the world because CNN was talking about Bitcoin. MSNBC was talking about Bitcoin. Celebrities were launching their own NFTs and coins and whatever. Uber drivers were talking about Bitcoin. Random ass people I met at the gym were talking about Bitcoin. Literally everybody was talking about Bitcoin. Why? Because Bitcoin was at all-time highs. Why? Because we saw huge displacement. So now what I'm trying to explain is displacement equals attention. Attention equals liquidity. Okay? When a market is moving, a lot of attention is going to be on that market. Attention is not often on slow moving markets or slow moving assets. It isn't assets that are moving, because now when we see assets moving, there's either the pain of regret, which is, I wish I had known, I would have bought this asset, or I wanted to buy this asset, but I did not buy this asset, so let me go and buy the asset. And there's also going to be traders who think you're smart and they want to go and sell against the trend or whatever. But when we see displacement, that brings a lot of attention to that asset class, and that attention equals liquidity, because you're going to be a lot of interest by market participants wanting to do transactions. Whatever kind of transactions, we don't care. We just know that there's going to be an influx of liquidity into the asset class. And the reason why I decided to use Bitcoin is because Bitcoin is a lot more, is something that we can relate to more, because everyone went through that phase where the whole world was hyped about Bitcoin and everyone was talking about Bitcoin and how to make tons of money on Bitcoin. So that's why I'm using this example. So when we see an asset that is moving, when we see displacement, displacement brings attention, attention brings liquidity. Okay. Now, as an asset or a market starts to displace higher, there is going to be interest from what we call retail liquidity. Again, it could be institutions, it could be retail traders, it could be any kind of market speculator, but there's going to be interest in liquidity wanting to be buyers. They want to chase the market. They want to be a part of the trend. They want to be a part of the displacement. And they oftentimes you're not entering or buying at optimal prices. Optimal prices is buying at a discount because they've seen the displacement. They are going to buy at a premium. You're going to buy an asset class that has already moved. We call them weak longs. Weak longs are not the guys who planned ahead for this bullish move. Weak shorts are not the guys who planned ahead for this bearish move. Weak longs are the guys who saw this bullishness and said, okay, I need to be a part of this trend. Weak shorts are the guys who saw this bearishness and say, okay, I need to be a part of the bearish trend. So what they do is as price makes new highs, as price is going higher and higher, higher high, higher low, that's a trend. Give me 1 second real quick. So as the market makes new highs in price, they will enter and try to participate in order flow. So you get weak longs entering the market here, and they will enter the market here. And you get weak shorts entering the market here, and they will enter the market here. Because the market has seen significant displacement. Think about what I said with Bitcoin. The market has displaced significantly. Now there's that fear of missing out, the FOMO. We call it FOMO, fear of missing out. I want to be a buyer. I want to chase the trend. I want to be a part of the trend. So I'm going to participate in the trend. And so we have weak longs here, weak longs here, weak shorts here, weak shorts here. So as the market goes lower, weak shorts will enter the marketplace. As the market goes higher, weak longs will enter the marketplace. Now, when the market gets into levels of higher level distribution, so now when I say high level distribution, I mean key higher time frame levels where institutions will seek to offset existing order flow. Okay, so I'm going to use a box, some random, unknown high time frame premium. Okay, that's what we're going to assume here. That's where this asset traded up into. And the same thing goes for our bearish example. So when the market gets into this premium array, as the market is distributed, oftentimes what the market would do is the market would seek open flow liquidity. Open flow liquidity in the form of existing sell stops. Why? If we have buyers at this high, right? Buyers will buy the breakout of major highs. Okay? As we have buyers entering into the marketplace at this high, and new buyers entering into the marketplace as the market makes a new higher high, where are they going to put their protective stops? Think. If you are buying with significant liquidity and you're expecting higher prices, where would you protect your position? Just think random logical level. Well, you're going to protect your position at the last major swing, right? And that major swing will be in form of a short-term low or a daily low. You're using that to mitigate risk. So what would happen generally is as we see a distribution of order flow at premium, the market oftentimes will seek to offset open flow liquidity from profitable positions. And because the trend is bullish, it will seek to offset open flow buy positions from the weak longs. Why do we call them weak longs? Because these are the guys who are entering into the market after the market has already seen significant displacement. So you're entering into the market when the market is close to a premium or at a premium. Of course, you're not going to be aware that the market is close to a premium or at a premium, but this is where you're entering into the market. And so the market will seek to offset these weak longs. Remember, the whole point about the market is liquidity. That's what trading is. If you ask, not even ask anyone. If you go on Google or you just search up what is trading, trading is simply buying or selling. If you want to buy, you need someone to sell to you. If you want to sell, you need someone to buy from you. And that's how you make a profit or a loss. Now remember, every business's purpose is to make money, is to make a profit. And that goes for the banks also. So they will make a run on weak buy positions with protective sell stops at the most recent major swing. That's what the fuck happened on gold. I'm gonna even explain this concept even more. It's gonna make a lot more sense, because oftentimes you could say, well, why did we not get this kind of displacement, this kind of move, running open float, bullish open float positions? Why did we not get this kind of move down here, or down here, for example, even though we had a minor stop? Why did we not get this kind of move down here or down here? Well, because this market was moving for a target, a higher level target. So what I'm explaining here is, in this phase here, you have a run on internal range liquidity, right? So this is simply what you expect. Internal range liquidity is going to be liquidity inside a defined dealer range. You have a run on, maybe this could be like a H4 low, H1 low, maybe sometimes a daily low, right? You get that run there. But when we see runs like this, we don't think the trend is bearish, because we have this as our target. And I'm going to explain how to understand or anticipate this as a target. Okay, now the market gets up into the target. As the market nears the target, it is nearing premium levels. Now, sometimes the market can get into the target and trade right through. I'm not going to try to do a presentation and act as if the market is every fucking time the market trades up into a near-term target objective, it's always going to behave like this, right? Just going to be a lot of times where the market will trade into a target like this and trade right through. Okay, just a lesson here. Just stick with me, all right? So, as the market gets up into this nearest target objective, it has this massive correction. Massive correction, seeking open flow liquidity from weak longs. Massive correction, seeking open flow liquidity from weak shorts. So what I'm going to do here is protective bullish sell stops from weak longs. Okay, so this is your stops here. Protective bullish buy stops from weak shorts. So now the market is making a run on protective bullish sell stops from weak longs. So late longs, market makes a run on them, and also late shorts, the market is making a run on their buy stops from this key high time frame level. Now the difference between this move, this one, and let's say a move like this where it is just a general retracement in the market, and we don't expect these kind of aggressive reversals, right, is that these kind of moves will occur at near-term to long-term target objectives or historical price levels. I'm going to repeat myself one more time because this is where you're going to include this in your model. When the market is at near-term or long-term levels or historical price levels, we don't go and look for continuation trades. We wait. I'm going to repeat myself one more time because this is where you start to include new stuff in your model. When the market is at near-term to long-term target objectives or historical price levels, we don't look for continuation trades. This is a low probability market condition. Irregardless if the market continues to trend, reverse, whatever, we don't give a fuck. We don't trade. We can monitor and, take notes and lessons, but we do not look for continuation trade whatsoever. Now, reversal trades, that's a different ballgame. That's a lesson for a TGIF trade. But we do not look to trade continuation trades. Because think about the concept of discount and premium. If we are in a bullish market environment, we don't want to be buying in a retracement from a higher time frame premium array, because that could easily be a reversal. This is where your lesson comes in. I'm smiling because it's starting to make a lot of sense. It's starting to make a lot of sense. A lot of sense. And I'm probably realizing this video is about an hour long, and so it's altogether interesting. And so I might make this like a 2-part lesson and give a go. So maybe if the first video on YouTube gets like, let's see, if it gets up to 500 likes, the first video, then I'll drop the second part of the lesson, because on the second part of the lesson, we're going to start to go through actual examples, right? So I'm just going through the concept of this, how to include this in your model. And because I am so hyped about the lesson, you can see we are 46 minutes into the lesson, and I don't want this to be like a long ass video. So I'll end this video here and I'll continue the second part. So what I need you guys to do is drop 500 likes in this video. Okay, 500 likes in this video. Again, I don't need anything from you guys. Just 500 likes in the video. It shows me that a lot of people are interested and they value my time, right? They value the fact that I'm sitting on a lesson for almost 50 minutes and I am doing an explanation, teaching. So if you actually value my effort, then I would love for you to drop a like on this, please. And if you want to subscribe, I would appreciate you subscribing, okay? Because I'm not monetizing on YouTube, so that'll go a long way to encouraging me. And I will drop the next one, the part 2, okay? So in the meantime, trade safe.